Hi guys, Max here, and this is of course your daily market update for yesterday, Monday the 6th of June. I'm awful with days and dates, that may have been wrong. Anyway, how was it? Well, for the most part, equities were a little bit mixed. As you can see, this is the S&P 500 heat map, and things were okay, but mixed. As I said, some companies like Google and Amazon performed quite well. Tesla's up 1.6% as well. Consumer defensives did a little bit poorer. And so for the most part, we didn't really see individual sectors moving in unison in one direction. We just saw individual companies moving based on their own change in circumstances, which is exactly how markets should operate, and that's really good to see. The S&P 500 then rose by about 0.3%, with the Nasdaq 100 rising by about 0.4%, just very slightly outperforming the rest of the index. For the other sides, we had the Dow Jones rising just marginally by 0.05%, and then the Russell 2000 did a fair bit better at 0.4% as well. For the rest of the world then, it was really just another mixed bag. We saw Chinese markets perform really strongly and South American markets perform really quite poorly, but then for everywhere else it was pretty much mixed, with individual companies making their own moves. The FTSE 100 then, by the end of the day, rose by 1.1%, and the Stoxx 600 rose by 0.9%. Now, as for currencies, the dollar spot index did rise very slightly by about 0.2%. The pound is now sitting at about $1.25, and the euro is at $1.07, which is pretty much around the mark where we've seen both of those currencies over the last few weeks. Now, for fixed income asset markets, for the bond market and US bond markets in particular, we saw yields rise across the board, with the US 10-year Treasury yield rising by 11 basis points back above that 3% mark, where it now sits at 3.04%. It seems that quantitative tightening might finally be doing its thing, and we might be on the verge of seeing that consistent rise in yields in the US markets that I've been expecting for some time now, week after week. For commodities then, oil prices have risen over the weekend. They are maintaining their very high levels, with WTI crude rising by 0.3% yesterday alone, and it's now sitting at $119 a barrel. Brent crude is just a touch higher at $120 a barrel. Those are both really high levels for oil prices. Go back any amount of years and that would be the end of the world kind of bad, but because we're now in this new monetary environment where commodity price inflation is just insane, well, it's almost seeming normal to a lot of people. Gold then, which has been widely expected to be an inflation hedge but hasn't really performed brilliantly as one so far this year, well, it's maintaining that same status quo of not performing as well as you might expect, with inflation and commodity price inflation in particular being so large. Gold is currently sitting at $1,840 an ounce. As for crypto then, well, as you can see, it was a very bad day in particular, but this isn't quite as bad as it does look. Yes, there is red all over here. Yes, every single altcoin, every major coin is down for the day. Bitcoin's down 6%, down to $29,500. Ethereum is down almost 8% to $1,750. And yes, this is by no means a good day of performance, but we did actually see crypto pump a little bit over the weekend, with Bitcoin rising above $31,000 for a moment. So this decline isn't quite as drastic as it seems. Really, $29,000 Bitcoin we've seen consistently and many times over the last few weeks. Ethereum is doing a little bit worse, and altcoins a little bit worse as well, but this isn't quite the end of the world for crypto as this red chart would suggest. Now, why were stocks okay, but they weren't really pumping as much as a lot of people would like? If you look at them on a year-to-date basis, almost every stock is still down a really significant amount. The S&P 500 is still down by about 14%. The Nasdaq is down close to 20%. So why are stocks failing to rally? Well, it's the usual things we've seen repeatedly over recent months. The first is that there are really major fears that rising interest rates will hurt growth of companies, and it's also going to hurt their corporate earnings over the next year and into the future from there on, and that's a very justifiable fear. There are, of course, also still major inflation fears. There is this rising narrative that inflation has finally peaked, but I will caution you against just taking these people who say that at face value. These tend to be the same people who say that inflation peaked back in March, and then they said it peaked in February and January and December and November, and really they said there was never going to be inflation in the first place. So be a little bit careful and take what these people say with a grain of salt. Now, with that being said, I'm going to do the complete opposite of that and say that actually it is possible that inflation has peaked here. But even if it has peaked in nominal terms, in literal terms, that doesn't necessarily mean it's good news for the economy. If we maintain inflation at 8%, for instance, over 5 years, that's still absolutely awful for everyone involved. But inflation doesn't reach a new high, so technically it had peaked. Commodity price inflation right now is also really, really bad. As you can see from this article, things aren't getting better, and a global commodity index is at its absolute all-time high, i.e. we've never seen higher commodity prices in history before today. That's of course not good for inflation. Oil prices are sitting at $120 as I mentioned earlier. That's not good for inflation. And just because we might not be seeing 10% inflation due to the doctored Bureau of Labor Statistics CPI data over the next few months, well, that doesn't mean that things are getting any better. Now, in corporate news, there's quite a bit about Elon, but we've spoken so much about him and the Twitter deal recently that I thought I'd just shoehorn this into the normal video for today. I don't really fancy making an entire video talking about Elon and the Twitter deal once more, but there is a new development. Elon has sent a specific letter to Twitter, basically saying that he might pull out of the deal and it might be Twitter's fault, and so he isn't necessarily going to forfeit that $1 billion that everyone expects him to. And it's all based over these fake accounts on Twitter, the bots, and in particular, Twitter's fraudulent reporting of these bots, which they have now admitted to. They admitted that they were fraudulently reporting their number of daily active users for about 2 years now, so it isn't exactly difficult to see why this problem has arisen, in my opinion. Now, this here is the full letter that Elon sent, or his team sent. I'm not going to read it all. It's very long and most of it's very boring, but this part here in the bottom is actually rather important. And so I'll just quickly tell you what that's about. Based on Twitter's behavior to date and the company's latest correspondence in particular, Mr. Musk believes the company is actively resisting and thwarting his information rights and the company's corresponding obligations under the merger agreement. This is a clear material breach of Twitter's obligations under the merger agreement, and Mr. Musk reserves all rights resulting therefrom, including his right not to consummate the transaction and his right to terminate the merger agreement. So what that basically is it's Elon saying, yes, I'm thinking about ending this deal, but it isn't my fault. It's your fault for publishing false, fraudulent data and for not allowing me to now look into that data. Now, there is a lot of controversy surrounding this, but actually this tweet from Meet Kevin summarizes the situation quite effectively, in my opinion. So here it is. Some say Elon Musk has to buy Twitter as is with bots because he waived his right to due diligence, and Meet Kevin thinks that is wrong. According to the SEC, Twitter can be liable for omissions or misleading material facts. Waiving due diligence does not mean you have to accept a fraudulent disclosure, brackets, understated bots. And Elon replied to that saying, correct, he agrees with that. And that pretty much gives us confirmation that yes, this is exactly what Elon is worried about, and it's why the deal is in jeopardy. Basically, the argument here is that Elon's supposed deal and his offer waived due diligence, which is supposed to mean that he isn't allowed to scrutinize the deal much. He isn't allowed to scrutinize Twitter too much. But according to the SEC, the Securities and Exchange Commission, well, that doesn't constitute not being given fraudulent data. If Twitter is committing a crime by putting out false data, lying to investors, and they have done that, they literally admitted to it. So I'm sorry to people who disagree with that. Well, then this waiving due diligence isn't really relevant. The reason this is so controversial is for a couple of reasons. Firstly, every person who owns Twitter stock right now pretty much only does it because they want to sell the shares at $54 to Elon Musk, far more than the company is actually worth. And so they want this deal to go through. Stocks have been falling. On the other hand, the monetary environment has been tightening. And so a lot of people have been hypothesizing that maybe Elon regrets his decision to make that offer and he might be not wanting to buy Twitter for that $44 billion price tag anymore. Now, the other side of this is that if either party is the party which destroys this deal and doesn't want it to go through, well, then they will have to forfeit $1 billion in cash to the other party. A lot of people have been saying if Elon breaks it down because of bots, then he will owe $1 billion to Twitter. Elon and his team seem to think it's the other way around. The reality is this would be a massive court case. It would not be resolved over Twitter. It's not going to be resolved by my YouTube video. It would take years and years of some of the best lawyers in the world trying to make their point. Now, what will happen from here on out? Well, I don't really know. No one does. Only Elon knows what he really wants from this. Some people think that he wants a discount to his deal. He wants to buy Twitter for a lower price than he previously offered. And he's using this bot controversy as leverage to try and get a better deal. Some people, as I mentioned earlier, think that Elon doesn't want to buy Twitter at all anymore, and he's trying to use this bot controversy to break up the deal altogether. And then some people just think that Elon isn't happy with the fraudulent data that Twitter has been publishing, and he wants the world to know it. Really, I don't know which of those is the case, but I do know that this isn't going to disappear overnight. If you own Twitter for the arbitrage opportunity, well, if it goes through, you're going to make a lot of money. I think Twitter was down another 5% on this news because it makes the likelihood of this deal going through a little bit lighter. And so there's a good opportunity there, but there's also a huge amount of risk. Next, in corporate news, we have Amazon's share price falling by 95% overnight, which sounds really, really awful until you remember that news from a couple months ago about Amazon posting a stock split, a 20-to-1 stock split. So yeah, of course, it now being in the $100 range really isn't a big deal at all. But of course, there are going to be lots of people looking at the lower price of Amazon and thinking it's a deal. This article here encapsulates that perfectly, saying that Amazon's share price is in 3 digits. This is really great news. Should investors be buying or selling based on this news? And the reality is, actually, your opinion on Amazon should not change through this stock split. Now, there is a very small argument for buying Amazon or any company after a stock split, and it's based on the idea that some brokers don't allow fractional shares. And so when a company's stock falls from $2,000 or $3,000 down to $100 or $150, well, suddenly more people can invest in the company. But the reality is the vast majority of platforms these days do offer fractional shares. And so that increased buying pressure is going to be really rather minuscule. I would encourage anyone who's considering buying Amazon because suddenly it looks a lot cheaper to just think things through a little bit. Really, this change, this share price split should have absolutely no impact on whether or not you're going to buy or sell Amazon. We're all far more sensible than that. Finally, for today, I mentioned yesterday that Boris Johnson, the Prime Minister in the UK, was facing a leadership rebellion, a vote of no confidence, and that we'd probably know the result by the next video. And it's the next video, and we know the result. And basically, Boris Johnson won. Now, this is mostly politics, so I'm only going to touch on this very briefly. I will be putting out a full-length video on Stoic politics later today, looking at this rebellion, at this vote of no confidence, and basically giving my 2 cents on the whole issue, and why basically I don't really think it's a major deal, and I don't think we're going to see a major impact to the Tory party here in the UK. So if that's interesting, then check out the link down below in the description or the comments for Stoic Politics. That video will be coming out a few hours after this one. Now, as for the impact of this to the markets, there really shouldn't be much of one. We have the same government, we have the same prime minister, we probably have mostly the same policies, so we shouldn't really expect much of a financial change to the markets. There's a little bit less uncertainty, which usually is a good thing. And then there's this idea going around that the Conservative Party hasn't been very conservative recently, and I firmly believe that. A lot of Tory backbenchers who voted against Boris in this vote of no confidence, well, they firmly believe, for the most part, that the Conservative Party isn't very conservative. So maybe we see some more conservative policies coming up, some lower taxation, some smaller welfare state, things like that, which in the long run should be good for markets. But again, really, this is quite a major change, and I don't really expect this to have any major impact into the future. Now, as for the rest of this week, we do have a few things to look forward to. Firstly, we have the Reserve Bank of Australia publishing their decision regarding interest rates for this month, and that comes out later today. We then have the Reserve Bank of India doing the exact same thing, and that comes out tomorrow. We then have the European Central Bank, their interest rate decision coming out on Thursday. And for that, that's actually quite a major piece of news. We are expecting to hear about the end of quantitative easing for Europe. It's about damn time. This has been long overdue. It should finally come, though. They should be announcing their final wind down of asset purchases, and then eventually, hopefully, asset sales as well. I don't think we are expecting an actual interest rate hike this month. We're probably expecting the ECB to prepare everyone for an interest rate hike next month. Again, long overdue. Inflation in Europe is ridiculously high, and President Lagarde is mind-numbingly useless. Finally, then, come Friday, we have the United States' CPI data coming out, which is going to be really important for markets. This is the thing that has been keeping everyone on edge. It's whether or not inflation in the US is getting worse or not. Actually, I do expect relatively low numbers, lower than you might expect me to expect. But really, this probably won't be the good news that you're praying for. The low numbers will likely be due to deflation being seen in the used car market and things like that, which isn't actually impactful on many people. And the reason inflation is so bad is because it eats away into people's savings, into their disposable income, and it drives the economy to a halt on its own, as we've seen with companies like Target and Costco and Walmart seeing their corporate earnings getting slashed time after time after time because people just don't have much money anymore. Guess what? When used car prices fall, that effect isn't going to change. So even though the headline figure of inflation may drop a fair bit over this month and maybe even the next few months as well, I don't expect the impact of inflation to be any really reduced. That is pretty much it for today. I'm of course back in my study. We're back to our full schedule. There's hopefully going to be 2 finance videos coming out each day and 1 or 2 videos on politics coming out each day as well. Again, check out Stoic Politics down below in the description and the pinned comment. If you like this kind of video, you'll probably like that kind of video as well. It's the same format. It's still me speaking. It's still my thoughts just regarding politics and less so on finance. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.